Okay, I think we should go ahead and be fine to start. Can everybody see my screen?
Yep, we see it.
Yep.
Okay, cool. Thanks everyone for joining us today for Refinancing and Taxes webinar put on by us, Leung Real Estate Associates, joined by Boston & Company and US Bank. So thank you so much for Sammy and Assad for joining us. If you guys want to go ahead and maybe introduce yourselves.
Yeah, thanks, Elizabeth. Hi, everybody. My name is Assad Taheri. I'm a mortgage consultant with US Bank. I've been in the business for about 16 years and working with Wilson's team for now almost 2 years.
Great.
Thank you. This is Sammy Basta. Thank you for having me. I'm a practicing CPA local here in San Francisco. I been in business for over probably 20 years between public and private accounting. Graduated from Notre Dame here in University in California with MBA in finance, and we work closely with real estate professionals, small business owners, and tech startups. So. Great.
And this is our team here. I'm Elizabeth, I'm the marketing coordinator, and these are our agents here on the screen. So whoever is on the call today, do you guys want to go ahead and introduce yourselves?
Hi everyone, I'm Ashley. I'm a sales agent here on Wilson Leung Real Estate team. I just really appreciate everyone for joining us today. Hoping that we can get all of your real estate related questions answered, as well as refinancing tax questions.
Keyboard?
Let us know if there's anything we can do to help, and I believe Wilson's on here.
Thanks, Ashley. I'm Wilson. I take care of the custodial. I'm just kidding. I started a team about 9 years ago, and I do take care of all the things that I need to, not just, of course, the buying and selling, but if there's anything that you guys have questions for, you're more than welcome to reach out and ask us. Today, our guests, Sammy and Assad, are going to be the people that you're going to want to have conversations and have questions for. So thank you, gentlemen, for being here. Thank you, Ashley, for everyone on the team, and also all of our guests that have joined us today to learn. And I think Wesley is here too, so.
Hi there, everybody. My name is Wesley. I've been on Wilson's team since 2017. I want to say thank you for joining us, and thank you to Assad and Sammy for hosting with us today. They're going to have a ton of good information for you guys, so definitely feel free to ask any sort of questions that you guys might have.
Hey everyone, I'm Jenny. Jenny Locke. I've been on team for about 4 years and excited to learn more alongside with you guys. I bought my initial first investment property at the age of 23 and did some refinances, and doing some 1031 exchanges. So today I'm excited to learn alongside with you on more of the taxes, as I just did a 1031 exchange to see how that might implicate me for the future investments. And I'll pass it on back to you, Lizzie.
Great, cool. So we next is that we are social, so we would love to connect with you guys. We post on Facebook, Instagram, and YouTube. We try to post a couple times a week just to educate you guys. So if you want to, just go ahead and give us a follow. We're basically WLREA on all social platforms. Cool, so we'll go ahead and have Assad kick it off with all things refinancing. If you guys have questions, go ahead and put it in the chat box, and Ashley will be moderating that, and so she'll be jumping in with the questions that you guys have, and then we'll go to Sammy afterwards, and then we'll do like an overall Q&A at the very end. So cool.
Cool. Thank you, Elizabeth. I appreciate it. All right, so this is our first slide. I'm sure as everybody has been paying attention to the media, whether you're surfing the internet or looking on the news, rates have been falling dramatically all year, but more significantly the last month. 30-year fixes, I've seen them as low as like 2.625, but looks like the average on here is maybe around 2.88. 15-year fixed is very low. The fixed products is where the mortgage rates have fallen most significantly, particularly also on the conventional loan sizes. When I say conventional, it's going to limit your loan amount to $765,600 in most of the Bay Area counties. Bay Area is considered high cost, so the max conforming loan limit, again, in the Bay Area is going to be $765,600. And that's where you're going to get these attractive 30-year fixed rates in the twos. The jumbo mortgages are not as low. The difference is that the conforming loans are backed or serviced by Fannie Mae and Freddie Mac. And then jumbo mortgages are portfolio products where the bank itself lends its own money. So they follow a different set of guidelines and they have different interest rates. If you can move on, please, to the next slide. So refinancing options. Why would somebody want to refinance? There's several reasons. So the first one would be possible cash out refinance. So if you've owned your home for a certain number of years and you put some good amount of money down, and throughout the years in the Bay Area, as property values appreciate, you've built more equity. So if you want to leverage that money to potentially remodel the house, possibly invest, possibly if you have children going to college, or if you want to maybe buy an investment property. So you could leverage it for any reason. The banks don't really care what the reason is for the cash out refinance. They might ask you and you just provide a simple letter of explanation. But as long as you have the equity and you qualify, then you can, again, leverage your equity and pull some of that money out. And right now with rates being so low, it definitely is a good opportunity to leverage it at a low interest rate. So that's, the number one reason people would want to refinance. Number two is going to be cash in refinance. So that's if maybe you have come across a big chunk of money, whether it's a bonus, restricted stock unit, or an inheritance, and you want to pay down your mortgage. So you could do a cash in refinance where you use that money to pay down your principal and you refinance it at a lower balance. And then, of course, if your interest rate is higher than where the market is at, then you want to see if a lower rate is going to benefit you. You want to make sure that there's a break-even point and there's a benefit for you to refinance. So that's where the mortgage banker is going to crunch the numbers for you and see if the cost that makes sense for you versus how much you're going to save. Okay, if we can please go to the next slide, Elizabeth. Changing the loan structure, that's another reason to refinance. So if somebody has an adjustable rate mortgage, most people might, if they did an ARM, they might, for example, have a 7-year ARM where the rate is fixed for the first 7 years. With 30-year rate mortgages or 15-year rate mortgages being so low right now, it does make sense for people to do a quick mortgage checkup to see if it would benefit them to refinance their ARM into a 30-year fixed or a 15-year fixed mortgage product. Or some people might have a 30-year fixed and maybe they foresee they might be selling the property in the next couple of years. So if they can go from a 30-year fixed to an ARM and their rate gets lower because they know they're going to be selling the property in the next couple of years, that's also an option for people to consider. Changing the loan duration. So if you have a 30-year fixed and you want to try to get that mortgage paid off sooner, you can refinance it to a 15-year fixed. There are options as low as a 10-year fixed mortgage as well. So that'll help you pay off the mortgage much faster and it'll help you save a lot of interest over the life of the loan. We do have Excel amortization tables. If anybody's interested, I could share that with you and we could do a comparison and you could see how much interest you could potentially save if you, converted your product from a 30-year to a 20-year or 15-year fixed. Another reason to refinance is to remove private mortgage insurance, PMI. PMI, as some of you may know, is applicable if you had put less than 20% as a down payment. So if you do have PMI and your property value has appreciated, or if you want to come in with some additional money to pay down your principal, and you're going to be able to get to enough where you have 20% equity in the property, essentially 80% loan to value. When you divide your loan amount by the value of the property, then your PMI could be eliminated. And that'll help you save on your monthly payments. There's going to be no more PMI. And with rates being low right now, most likely you may be able to lower your interest rate as well. And then finally, reverse mortgages. That's something I've never done myself personally, but I work with, or I have contacts with different banks. And if it's something that you'd be interested in, I could refer you out to somebody who specializes in a reverse mortgage. Real quick, just to touch on that, a reverse mortgage is more for somebody who are in their seniors and they want to leverage the equity they've built in their house as an income stream. So instead of you making a mortgage payment, the bank would give you monthly payments based on how much equity you have on your property and some other factors. All right. So requesting a quote. Requesting a quote shouldn't be too complicated. There's a lot of online sites that you could go to, but they do request a lot of information. You have to input a lot of personal information. However, if you are in touch with the mortgage banker, we should be able to give you a quote within a minute or two. And some of the items you see on the slide right here would be helpful for you to have handy in order to get the quote very quickly. So the first one is just going to be your loan to value ratio. Essentially, how much is your total combined loan amount? If you have a first and a second mortgage, add both of those loan amounts up. And then you can look up the estimated value of your property. There's a couple of sites that are pretty accurate. You could look at Redfin or Zillow to get a rough estimate. And of course, whenever you do start the process, we would get an appraisal to get the actual appraised value. But if you divide the loan by the estimated value, that'll give us an idea of the LTV or loan to value ratio. The lower the LTV is, the better interest rate you could potentially get. The next one is your credit score, of course. Credit scores typically are in brackets of 20 points. So for example, 700 to 720 will give you one set of interest rates, 720 to 740, and so on and so forth. The higher your credit score, the lower the interest rate could be. The loan amount. So I touched on the loan amount earlier. Again, just to reiterate, the conventional loan amounts of $765,600 are where rates are most competitive. So if that's an area that you guys fall in, it does make sense probably for you to get a mortgage checkup and see if a refinance could benefit you. Your property type. Property type sometimes affects rates depending if you have maybe a multi-unit property, like a 2-unit, 3-unit, or 4-unit. Lenders look at those possibly with, they view them as a little bit more riskier type of property. So therefore the interest rates could be a little bit different. But if you have a single family home or condominium, the rates are the same for those type of properties. The occupancy of the property. So there's 3 ways you can take occupancy of a property. It could be your primary residence, and that's going to give you the lowest interest rate. The second way is a second home or a vacation home. You'd have to occupy the property at least half of the year for it to be classified as a second home or vacation home. You could rent it out the other half, and it would still be considered a second home or vacation home. And the rates on those properties are actually very similar to primary. So there's not a big difference between the interest rates between a second home and a primary residence. The variance or the difference does come into play when you have an investment property, also known as a rental property. So the interest rates are going to be higher on those type of properties. However, considering where the market is at again right now with the low rates, I've been quoting some clients purchase rates as low in the low 3s for investment properties, which is very attractive for an investment property on a 30-year fixed. Investment properties also do require some more equity in the property compared to primary residence. The next bullet point is your liens, how many loans you have on the property. Maybe you have a first mortgage, a second mortgage, a home equity line of credit. So we'd need to know that information. And then finally, the transaction type, whether it's going to be a cash out refinance or just a straight refinance where you're paying off your current mortgage. Okay, thank you. If we can go to the next slide.
You kind of addressed this, just quick questions that David came through with. What's the lowest interest rate you've seen right now on a rental property as far as refinancing it? I think you said, it was the low 3 that you said part of the refinancing as well?
Yeah, thanks for asking that clarifying question. So purchase rates and refinance rates are always going to be different, and I've noticed that that's the same no matter what lender you work with. Purchase rates are going to be lower. So the rate that I mentioned was for a purchase. So 3.125 is the lowest I've seen on an investment property. for a purchase on a conventional loan. Again, $765,000 loan amount or lower. For a refinance, I've seen them as low as 3.625. So maybe 0.5% higher on a refinance.
Appreciate that. And then the question also asked what local banks we recommend for refinancing. US Bank, Assad's with US Bank. So he's absolutely one that I know some of our teammates have used as well. Assad, are there different types of maybe banks that you would recommend for certain types of refinancing? Yeah,
definitely. That's a good question. And the way I work is my work ethic with my clients is always long-term and relationship-based, and it's not transactional. So our rates actually on our refi transactions over the last few weeks have been a little bit higher, and the bank has intentionally done that to curtail our volume so we can catch up on our operation side and get back to quicker closing times. So I've been referring clients out who have conventional loans to mortgage brokers. Mortgage brokers right now are actually the most competitive when it comes to conventional loans, $765,000 and below. So I have a few brokers that I've met through the years, and I give 2 or 3 contacts out to the clients that reach out to me for the conventional loans, and I've been referring out to them. I've seen primary residence rates as low as like 2.5% over the last few weeks with some of the brokers I've been working with. So I'd be happy to connect you guys with other lenders. If we see, my rates aren't as competitive, I'm happy to connect you with other lenders.
Thank you, Assad. And I've seen that before. You've shared them with many of my clients, and we're very appreciative. And so if anyone is interested in those, feel free to reach out to Assad. He's happy to pass those along.
Thanks, Ashley. All right, so moving on to the next slide, the closing costs. So closing costs can be taken care of one of 2 ways. One way is that as the borrower, you pay for it. You can pay for it at closing out of pocket, or you could roll it into the loan. And the closing costs are roughly the same no matter what bank or mortgage broker you work with. They should be roughly in the range, depending on what your loan size is, but the closing costs should be roughly in the range of about $2,800 to, let's say, $3,800 on the high end. If your loan amount is bigger, if it's, let's say, a $1.5 million loan, the escrow title fees are going to be a little bit higher, so that's why I say $3,800. But if you have a lower loan amount, for example, let's say $400,000, then you'll be maybe at about $2,800 for your total closing costs. So let's just say as an example, your loan costs are $3,000. You can again roll that into the mortgage. So if your mortgage is $400,000, you can increase your loan amount to $403,000, and you don't pay for anything out of pocket, or you could pay for it yourself at closing. And then the third way that a lot of you may have seen advertised is something that's called a no-cost refinance. And the way that works is that there's a lender credit that's associated with your interest rate. So a lot of people may not know this, but there's always either credit linked to the interest rate, or there's a buy-down cost linked to the interest rate. So as an example, let's say a 30-year fixed is at 2.75%. and you're getting a lender credit of about $4,000 at that rate. So that credit could be applied towards your closing costs, therefore making it a no-cost refinance for you. Interest rates go in increments of 1/8%. So you can go 1/8% lower, or even 1/8% higher if you want to get a larger credit. So you can essentially go to 2.875 and get a bigger credit if you want, and then you can apply that credit towards other things. But let's say if you want to go lower, at 2.625, you wouldn't, as on this example, let's say at 2.625, you don't get any credit. So it's at 0. There's no credit for you. So in that situation, that's when you pay for your own closing cost of about $3,000. Now, if you want to go lower on the rate at 2.5%, then you'd have to pay what's called a buy down cost. So you're essentially buying your rate down to get that lower rate. And there's a simple, division and arithmetic equation we could do to see what the break-even point is, to see how many months it's going to take for you to recoup that credit that you missed out on with that lower interest rate. So that's something, that me or any loan officer you're working with could crunch the numbers very quickly and let you know, for example, if you go with a 2.5% rate instead of 2.625, it might take you 4 years to recoup that credit that you missed out on. And that information can help you decide, what interest rate is best for your goals. Hopefully that makes sense. Any questions on that part?
We did have a question just come in. If you've had a recent appraisal, does that count towards can you use that appraisal when you refinance? How long is an appraisal valid for?
Sure. Yeah, that's a good question. So because of what happened in 2008 with the real estate crash, after that, there was a lot of regulations that passed, and one was called the Home Valuation Code of Conduct, and that affects appraisals, and it doesn't allow appraisals to be transferable. So the appraisal has to stay with whichever lender that you had it with. So even if it was done maybe a month ago, we couldn't transfer that appraisal. However, on some of these loans on the conventional product, I have seen appraisal waivers. The conventional loans are run through an automated software, and they issue an initial automated underwriting approval. And if that software says appraisal waiver, then there wouldn't be any appraisals required. There's no inspection required. So you would save on the appraisal fee, and you don't have to worry about doing an appraisal. So the things that I've seen that impact appraisal waivers is that if your current mortgage was a Fannie Mae or Freddie Mac loan, so you're essentially refinancing into the same type of product, that really, I've seen high rates of appraisal waivers on those type of products. And then I've also seen situations where people have estimated their property values at over $1 million, and they never get an appraisal waiver. So for whatever reason, the system doesn't like it. If the property value is over $1 million, they're not going to waive the appraisal. So let's say if you're doing a refinance and you owe $400,000 and you know your house is worth $1.5 million, you have plenty of equity, even if it comes in at $900,000. Just tell the loan officer to put the value at $900,000, because that might give you a chance of getting the appraisal waiver. Just a little, I guess, a footnote for you to take away if you do that. Okay. Yeah, if we can go to the next slide, please. All right, so HELOC, that stands for Home Equity Line of Credit. So the HELOC could be in first position if somebody has a property that's free and clear, so they don't have a first mortgage, you can put a HELOC in there, or it could be a second mortgage. And essentially what a HELOC is it kind of acts like a credit card. The bank will see how much equity you have, and they could issue you a high credit limit on this HELOC. And you can let it sit there with a zero balance, just like you do with a credit card. And you would use it only when you need it. And whenever you do use it, you would just make an interest-only payment on it for the first 10 years. So the minimum payment requirement is interest only. You don't have to make a principal payment on it, but you can if you'd like. The HELOC interest rate is tied to the prime index. And the prime index right now is at 3.25%. So depending on what bank you're working with to get a HELOC, they might add a margin on top of it. So it'll be the prime 3.25 plus whatever they add on top of it. And then that'll be your interest rate on the HELOC. The HELOC is variable. So depending on what happens to the prime index, your interest rate is going to change. The prime index is not something that changes daily or monthly. It typically only changes if the Fed changes the Fed funds rate, then you'll see movement on the prime index. So my point of view is right now for the short term, the HELOC is pretty stable. It is a pretty cheap way to access credit. And if you feel like you're going to be paying off the debt pretty quickly and within the next 1 to 2 years, it is a good option to do a HELOC to leverage that. And it's always good to have, even if you don't plan on using it. You can just apply for a HELOC and just let it sit there as an emergency fund in case down the line in the future something comes up, there's an emergency, or maybe there's a great investment opportunity, you have that HELOC to leverage. And then there's only a 10-year drop period on your HELOC. So if you get your HELOC, just know that you have 10 years to draw on it. After that, the drop period expires, and then you just apply for a renewal on your HELOC. And then the next point on here is the next way, I guess, to leverage the equity on your home, which we talked about earlier, is the cash out refinance. So the difference here is that with the cash out refinance, you're putting whatever you're leveraging, whatever money you're taking out, you're rolling it into that first mortgage. So you don't have to worry about it being variable. It could be, it's going to be locked into whatever type of program you have, whether it's a 30-year fixed, 15-year ARM, 7-year ARM, whatever it is, that's the product is going to be locked on, so you don't have to worry about the rates changing. So that's the benefit. But the con is that you're going to start paying interest on it right away. So if you're going to do a cash out refinance, you want to make sure that you have an immediate need. You don't want to just do a cash out refinance and just let the money sit there and you don't really have a purpose for it. If that's the situation, then the HELOC is a better option for you. Okay.
Todd, we had a question with the HELOC. Does having a HELOC negatively impact the ability to get a loan in the future as long as the HELOC is still active, even if they haven't used it yet?
Yeah, that's a good question. So if the HELOC is already open and active, then I can speak with our guidelines, and I've worked at a couple of other banks as well, but for the most part with other banks, it's not going to affect your qualifying for a future purchase. So the only time it would affect it down payment, then the bank is going to use a qualifying payment for that HELOC. They're not going to just use what the interest only payment is. They have a higher qualifying payment that's a little bit more restrictive, and that's going to be the payment that they're going
Lose him.
I think we might have lost Assad for a second.
Yeah.
Oh, there you go.
There we go. Welcome back.
Everybody was frozen, yeah.
You were right in the middle of talking about how that could negatively affect potentially.
Yeah, so the way it could potentially negative affect you is if you're going to leverage the HELOC for a down payment, it's not really a negative effect. It's just that we have to use a certain qualifying payment to qualify you on the new purchase, if the HELOC is your down payment source. So let's say, for example, you're buying a new home and you're doing 20% down and you want to use $100,000 from the HELOC. With US Bank, we use 1% of whatever you're using for the HELOC as a qualifying payment. So 1% of 100,000 is going to be $1,000 a month. So you'd have to be able to qualify with that payment in order to get the new home purchase. It's a little complicated, but I'm happy to, dive in a little bit deeper if you guys like.
Thank you. We had another question come in. It's actually one that I have as well. How much time, if you recently got a mortgage loan, how long should you wait to refinance, and is there a time period that's required?
Okay, yeah, that's a good question. So with major banks, there's really no waiting period. So if your current mortgage is with a major lender like US Bank, Bank of America, Wells Fargo, you should be able to refinance even a week after you close on your purchase. But if you've closed with a mortgage broker, from my experience and what I've heard and some of the things I've seen, they might have a wait period of possibly like 4 to 6 weeks, 4 to 6 months. They might have like a 4 to 6 month wait period, because the way they get compensated is through the wholesale or correspondent lender. And then I think they require them to have a certain number of months for them to wait before the loan could be paid off. Okay.
Thank you.
Sure. Okay, so how does the Federal Reserve affect mortgage rates? So if you guys might recall, I think it was March this year, that's when the pandemic first had started and the Fed was trying to help curtail any type of recession. They cut the Fed rates near zero. As soon as that happened, I think it happened on a Sunday, my phone was blasting with phone calls because people thought mortgage rates were going to drop close to 0%. I wish that was the case, but that's not the case. When the Fed changes the rates, it doesn't have an immediate impact on mortgage rates. It actually takes much longer, and I think that's what's going on right now. We're feeling the benefit now. So it's been about 5 months later, and that's why right now we're seeing mortgage rates be under 3%. Essentially, it's not a direct impact, but it does benefit months later. And then the other kind of indicators on how mortgage rates are going to react. One of them is the 10-year Treasury note. That's always been a really solid indicator. You could just go on Google and type 10-year Treasury. So if the 10-year Treasury, if you see it going down, it typically means rates might improve. If it goes up, it means rates might worsen. And then the other indicator are mortgage-backed securities. Essentially what that is when banks close loans, they package it up together. Just imagine everything is bundled up, hundreds of $1 million of mortgages, and then it's sold in the secondary market. So one of the other things that have been helping mortgage rates right now improve is that as part of the stimulus package, the federal government made a commitment or a promise to purchase unlimited amounts of mortgage-backed securities. So that's part of the stimulus package, and that's what's also been really driving rates down. So in terms of like where rates are going to go, I think, I mean, for the short term, I think rates are going to hopefully be stable. I don't really foresee it increasing anytime soon. I don't know if it can go any lower than this, but it definitely is a good time to refinance right now. Okay, next slide is the mortgage payment moratorium, which I think essentially refers to any type of forbearance or deferment, which banks may allow. So again, as part of the pandemic, the government and a lot of lenders committed to allowing borrowers who have difficulties to have forbearance on their mortgages or deferment. So you could contact your mortgage lender directly, but make sure you ask a lot of questions in terms of how it could potentially impact you qualifying for a refinance. Because if you are in a deferment or a forbearance, it is going to be difficult for you to qualify for another purchase in the future or refinance your home. Depending on what type of loan program you apply for refinance, some products require you to be out of your forbearance or deferment for at least 12 months. So that's essentially what that product is like. Okay. And we have some Q&As on here that I could go through. We may have addressed some of these already. How soon can one refinance? We did touch on that earlier. How often can you refinance? You can refinance as often if you'd like, but just make sure it makes sense for you and you're not overpaying on closing costs. I think the information I provided earlier should be helpful for you to have a basis on how much the costs on a refi should be. So as long as there's an actual benefit for you and you're not, significantly overpaying, then you could refinance as often as you'd like. One thing also to do keep in mind is when you do refinance, it does reset your amortization. So if you do have, for example, a 30-year fixed mortgage right now and you're 7 years into it, you want to refinance to another 30-year fixed mortgage, it's going to reset it. Meaning that your first payment, a lot more money is going to go towards interest versus principal. Because as you know, as your mortgage gets older, through the years, more money is going to go towards your principal. So if borrowers are in that situation and they're, for example, 7 years into a 30-year mortgage, it might be more beneficial for them to consider a 20-year fixed or instead of a 30-year fixed. Are there any penalties to refinancing? After the 2008 crash, most lenders got rid of prepayment penalties. I haven't come across any type of loan that has a prepayment penalty in a long time, so you should not have it, but definitely you could just check with your current lender to see if your mortgage does have any type of prepayment penalty. Can you negotiate refinancing terms and rates? Yeah, I mean, you could always try to negotiate and compare different lenders. It's good to talk to maybe 2 or 3 different lenders. You don't need to have the lenders pull your credit if they give you a rate quote. You could just say, assume my credit score is over 760 and just compare with 2 to 3 different lenders and see who's giving you the best service, who you feel more comfortable with, and who has the lowest rate for you. Are buying points worth it? So I touched on that a little bit earlier. When you are buying points, you want to see what the break-even point is and how long you plan on staying in the property. So that's something the loan officer can do for you. So when you're talking to them about points, ask them, what's my break-even point? How many months is it going to take me to recoup these points that I'm paying for? And then at that point, you can make a decision if it makes sense for you to buy points or do the refinance with the lender credit and make it no cost. Will rates keep going down? I hope so. I mean, it's great for our business if it does, but it's really hard to tell. I think they'll definitely remain stable, but I can't tell if it's going to keep going down. All right. Is there another slide? Or was that the last one for me?
That's the last one. Thank you so much, Assad. We'll go ahead and have Sammy take over and cover taxes.
Oops, sorry. I need to unmute myself. Thank you, Elizabeth. Thank you, Assad. Great information. I want to start with my, biggest strategies that we use here in my firm with all my clients. My main focus when we talk about taxes with our client is those three principles. I want to see how much I can defer, how much I can deduct, and how much I can divide. So those are my biggest 3Ds that we approach and address any client engagement or questions when it comes to taxes. Think about deferral as you're kicking the can, down the road. You don't have to worry about taxes right now. So, and one good example of this is the 1031 exchange. That's a great vehicle to defer your taxes. That's another way to never pay taxes if you continue doing 1031 exchange for the rest of your life. And then, because guess when you die, your heirs will get that property at something's called the stepped up basis. So the stepped up basis, basically they will look at the date of death and look at the fair market value, and your heirs will inherit the property at the adjusted basis. So that's a great way, great example of tax deferral. Tax deduction. So once you optimize the first one, the tax deferred, then you got to think about, the current situation and see how much can you deduct in the current year. And there's a lot of example of deduction, depends on your situation. So if you're a first home buyer, and I'm going to cover this in a minute in my next slide, you got to look at your property taxes, mortgage interest. You probably would be able to itemize instead of taking standard deduction. Chamber contribution, they increased the limit this year to 100%. You got to look at any HSA, MSA accounts. You have to look at any income adjustment. Like for example, if you have a student loan, you can take the deduction for the interest that you're paying on your student loan payment if you're under the income threshold. So that's that's how you can optimize and maximize your tax deduction. So tax defer, that's not my first strategy. Tax deduction is the second. Now, if you optimize and exhaust all the tax defer and tax deduction strategies, then you got to look at how can I shift the income, or what I call it income shifting. For example, let's say you're in the highest tax bracket, right? And any other extra earned dollar amount, you're gonna be taxed at the highest interest rate, highest tax rate, 37.6. Well, you don't want to do that. So you got to figure out, if you're a business owner, well, can I hire my kids to get some of this business income? And that's a good example of income shifting. You want to channel the income from your tax return to any lower tax rate, whether it's a household, a relative, a cousin, another entity that you can set up and you can create for this purpose. For example, we have a lot of real estate professionals where they have a lot of passive income, and they cannot deduct it because they are a high earner, and you exceed the threshold. Once you get to the $150,000, then all your passive income is gone out of the window. It's not actually gone; it just carried forward to the next year. So that's another way. How can you set up? We have a strategy where you can set up a management company on the top of holding companies. You have your holding company where you have all your assets, then you have your management company on the top of it, where you can channel some of the passive income to the management company, and that convert. By doing this, you convert the passive income to active income, where you can get all the fringe benefits. You can get some wages out of it. You can do an IRA contribution. There's a lot of techniques that you can use in that way. So it depends on what's your situation and what your goals are, what you're trying to accomplish. It's very important to keep these main strategies in mind. Next slide, please. Okay, so let's talk about, so I did my slides in a way to, I want to touch base first on a home buyer if you're in the market to buy, a home seller if you're selling or exchanging, and real estate tax professionals if you are investor, rehabber, flipper, any kind of real estate professional. So I want to talk first about buying a home. If you are in the market to buy, there's a lot of tax benefits in buying. And that may be just very basic for some of you, because I assume not all of you are first home buyer. But just like, think about this as a refresher. So mortgage interest, that's one of the biggest tax advantage in buying a home. You're allowed to deduct the mortgage interest on your mortgage. Now, as part of the TCJA, the Tax Cut and Job Act that was enacted in September 2017, there were a lot of limitations on the mortgage interest. It used to be $1 million of acquisition debt and up to $100 of HELOC. Now the HELOC deduction is gone. You're only limited to, if you buy after January 2018, your deduction is limited to the interest on $750,000. Now, when they say the HELOC is eliminated, it's only if you use the HELOC for any other purpose than buy, build, or improve. So let's say, here's an example: you bought a home for $650 and you only qualified for $650, but then you got a HELOC from another bank or another lender to make the buy or the purchase. Then that HELOC is actually part of the acquisition debt. As long as it doesn't exceed the $750, you can get a full deduction of your mortgage interest. Now, we get a lot of questions about refi, and that can get a little tricky because there's no cut and dry answer for every situation. So what you need to keep in mind is if you bought before September 2017, your loan is grandfathered in, so you're logged into the old limit. You still can deduct up to $1 million. And the HELOC, again, that's excluded, that's not in the picture. But if your mortgage is less than $1 million and you try to refi after September 2017, your deduction is limited to the $1 million, the lesser of $1 million, or your current mortgage balance. So here's an example. Let's say your mortgage you bought in 2016. Talk about your home, not investment property, because investment property doesn't have any limitation when it comes to mortgage interest. If you have a mortgage prior to 2017 for, like, let's say $750,000, right? And you came in 2020, interest rate is, as low as it can get, and it's like, well, let me refinance. Well, great, but if you refinance up to $750, you still can deduct, mortgage on the full $750 because you're under $1 million. But if you refinance and you cashed out, it's like, well, I'm gonna get like $100,000 to go reinvest or invest or buy investment property. Only up to the $7,750, that's your original mortgage balance. That's all what you can deduct on your personal income tax. The additional $100,000, the cash out, you can use that as a principal for your investment property or whatever you're going to use. So if you use that $100,000 for personal use, go to vacation or pay credit card or buy a car or anything, that's not deductible, even though it's under the $1 million, because it exceeds your original current mortgage balance. But if you use that money to go acquire an investment property, then you can deduct that 100%, because by doing this, you convert the mortgage into a business mortgage. And when it comes to investment property, there is no limitation. So just keep that in mind when you think about refi. Point PMI, as you've heard from Assad, it's all deductible. It was on and off since 2017, but in 2020 and 2019, they extended the PMI and the points in the TCJA rules. Property taxes is another tricky part because as part of the TCJA, the Tax Cut and Jobs Act, they limit the deduction to up to $10,000. And probably you've heard that so many times in the news. People with high tax state like here in California, New York, New Jersey, they're screaming because, I mean, think about it. If you live in the Bay Area, right, and your median income, if you're a single taxpayer, can be what, like $120,000, $150,000. Your state tax withholding that can easily, make up that $10,000. So if you add to it any other state taxes, all these additional taxes, which is called state and local taxes, you cannot exceed $10,000. So all the additional taxes that you pay, it goes out of the window because you cannot deduct it, and it doesn't get carried forward. So that's one bad thing, which we're hoping, God knows who's going to be in the White House in October, November. That may change because when they say, a permanent tax code, there's not such a thing. There is no permanent tax. Basically, it's a permanent until we have a new administration, in my opinion, or a new Congress. So let's hope for, probably that, some change down the road for the limitation. So next slide, please. Okay, so if you are in the market also to buy, there are some financial assistance. Some of them are free, some of them are tax-free, some of them are penalty-free that you may want to consider in helping you with the down payment. So when I say penalty-free IRA distribution, let's talk about the three main type of retirement plan. You can see he can be participating in a group retirement plan, which is like 401k or 403b, and those are group administered plan. The other type of plan are traditional IRA, which is the regular, you can just go to a bank or any brokerage firm and open a traditional IRA for yourself. And there is the Roth IRA, which work exactly the opposite of the traditional IRA. So let's go over these three. With my first option, if I have those three or two or one, I will try to get free loan first from the 401k. So if you have a 401k, you're allowed to borrow up to half of the balance, capped at $50,000. So let's say you have $70,000 in your IRA, you can borrow up to $35,000. I'm sorry, up to half. So that's like $35,000. You take that money and you use it, and you can pay it over 5-6 years. It all depends on the IRA administrator. So you really have to check with your employer or the H&R. Some of them they have some restrictions. Some of them they allow you to borrow only up to certain dollar amount. Or you have to be employed for a certain number of days or years before you can borrow. But these are the tax code allow you to borrow up to $50,000 or 50% of the balance. So that would be my first option. The second option is if you have a Roth IRA. The great thing about the Roth is when you make contribution, it's not deductible. But when you take the money out, after 59, not 59 and a half, I'm sorry. If you have a Roth IRA that you have it for 5 years, you can take all the money out, including the earning, tax-free. But here's what I see a lot of confusion. Your contribution to the Roth IRA, you can take that money out anytime, and there's no tax implication. Because think about it, the contribution part itself, it's not earned income to you. So you put $50,000, even if you're under 59 and a half, you can go anytime to the second day you open the Roth IRA, take that money out. So that will be my second option if you still need money for the down payment. So loan from a 401k, that's tax-free. Roth contribution, distribution from Roth IRA. And then the third one, I will consider the traditional IRA. So when the traditional IRA, there is a provision with the traditional IRA. The IRS allows you to take distribution, taxable distribution, up to $10,000 if you are a first home buyer. Now, it's a penalty free. That means that you wouldn't pay the 10% penalty to the IRS or the 2.5% to the FTB, California franchise tax, but you still have to pay the taxes. So let's say someone, if you're, let's say in the 25% bracket, right? Federal. So you add, if you take that distribution, $10,000, you add 25% to roughly about, that will, add about 8% state. So that's about like 33%, one third of the distribution that will go to the government. So I will keep that at the last option, but just, it's an option if that's the only option that you have. So that's the order what I will go in tabbing into one of these retirement plans. Next slide, please. Okay, so now if you're in the market to sell, there are two things to keep in mind. Understand the short term and the long term. I think most of you are familiar with this. Well, short term, if you are selling your home and you have it, you kept it for less than 1 year, then that's a short-term capital gain. Short-term capital gain equal your ordinary tax rate. So there is no short-term capital gain bracket. It basically depends on, you get taxed at your current ordinary tax rate. So if you are in the 25% tax rate, that's what you pay on the capital gain. If you're the highest one, 37.6, that's what you pay. So, and that's the problem with the short-term capital gain. There's no fixed rate. You treat it as like any active income. Long-term capital gain is, on the other hand, it can go from 0 to 20%. Well, you've probably never heard about zero. Yes, if you are an individual with less than $40,000 taxable income, you're basically paying zero on any capital gain, and that works great. I see that with a lot of clients. If you are like on a limited income, like on a pension or Social Security, you bought a home 20 years ago, now it's time to sell it, and you have a huge, big equity, and you have a huge capital gain. A lot of them end up with paying zero capital gain because you are under $40,000 if you are, or if you're married filing jointly and you're under $80,000, then you pay zero. 15% is basically depends on your ordinary tax rate. So you have to look at what's my ordinary tax rate. If you're up to 35%, then you're paying 15%. Anything higher than that, you pay the 20%. So I don't see a lot of people paying 20% capital gain, unless if you're on the high tax bracket. If you make like over $500,000, you probably hit the high tax bracket. But if you're under 35% ordinary tax rate, then you're paying 15%. Section 121, that's probably some of you are familiar with this. This is another provision in the tax code which allows you to exclude up to $250,000 of your capital home, or for your capital gain, if you sell your primary residence. That only apply to your primary residence. So if you're selling your vacation home or your investment property or any other type of property, that doesn't apply. That's only for primary home. It's great because you can do that every 2 years. I have my, a friend of mine that he used to do that. He's like, doesn't have any family, love to travel. Every 2 years, he buy a home and keep it for 2 years, as long as he keep 2 out of 5 years, and then sell it and get the capital gain exclusion. If you're married filing jointly, you double that number, so you can get the exclusion will be up to $500,000. Now, keep in mind that they changed the rules in 2009, I believe, 2009 or 10. So it used to be the only rule that you have to comply with is 2 out of 5 years. Any 2 out of 5 years doesn't have to be the first, the second, or the middle. But they added another restriction in 2009 and say any non-personal use of the property that will reduce your capital gain exclusion, which means that if you bought a property back in 2015, you lived there for 2 years, right? So now you meet 2 out of 5 years. And then you moved out and you rented out. The 3 years, the remaining 3 years that you have, that will reduce your capital gain exclusion. So you would only get 2/5 of the capital gain excluded on 2020 when you sell the property. There's another code that's a 1031 exchange, which probably a lot of you are familiar with. And there is a really unique way to combine both the 121, section 121 exclusion and the 1031. So let me give you the short version. If you, let's say if you buy a property and you stayed there and you treat it as your primary home for 2 years, you moved out, you rent it for the last 3 years, then you sell it. So when you sell the property after 3 years, the property is a rental property, right? But you already lived for 2 years out of the 5 years. So you're still gonna get partial exclusion for those 2 years because you can apply the 121. You're not gonna get full exclusion. So 2/5 of the capital gain will be excluded, and then you can do 1031 exchange for the remaining balance. That way you would pay 0 taxes. That's probably the best scenario if you can make it that way. I know that sometimes it's hard to play the timeline and figure this out, but just keep always in mind it's always about planning. So you cannot just think I want to sell next month and I want to get like some tax deduction. You really have to think about planning. You want to buy, you want to sell, you really have to plan for it. Next slide, please.
Before we move on, can we had just a couple quick questions.
Sure.
And one of them is about the last slide. Are you able to share more about the CARES Act and withdrawals against your 401k for home purchase just during this time?
Yeah, sure. That's a good question. So the CARES Act allows you to take a distribution out of your either IRA, 401k, or traditional IRA up to $100,000, but that's only for financial hardship. So you got to be very careful. I don't see anywhere in the code to say that you can go take that money and go invest or buy home. That's my interpretation. I think buying a home or acquiring a home, that will be a hard story to tell. And that's in my opinion, does not qualify as a financial hardship. So this is just to someone struggling to pay the bills or to get by, but not to acquire or go make any purchases. But it is available out there. Yes, you can pay that distribution over 2 years. So you can pay 50% in 2021, 50% in 2022.
Okay, perfect. And you had another past slide that said referred to energy credits.
I'm sorry. Yeah, I was talking too fast here, so I need to slow down. Okay, so the energy credit, it's really a great credit that was implemented in 2016. So 2016, they allow you, the .S code allow you to deduct up to 30% back in 2016 of any energy efficient improvement that you put on your primary home. The credit got reduced in 2019 to 26% and to 22% in 2020. So if you're making an improvement in 2020 this year, you only allowed up to 22%. The nice thing about this credit is if your income is high and you cannot use that credit, you can carry it forward. So you wouldn't lose that credit. So that's always a good thing to look for if you're considering making any home improvement.
Thank you.
You're welcome. So I'll move quickly through here because I know I'm running out of time here. Capital improvement. It's a big question, and it's a major struggle for any home seller. When you sell your home, the biggest question is, how can I reduce my capital gain? How can I minimize my tax liability? And please keep in mind, when you buy a home, it's all about, you know, records. So you got to keep records of everything or every major improvement in your home. And I want to be careful in when I say improvement versus repairs and maintenance. So if you're fixing the bathroom, or you have a plumbing jobs, or you fix the backyard, that's not improvement. But if you're adding a garage door, if you're adding a room, if you're putting a new roof, that is a major improvement. So think of improvement as any addition to your property that will increase the value of the property, and the value will go beyond 1 year. So any like you're doing a renovation, you're doing a rehab, you're putting a new kitchen. Those are a good example of improvement. Now, how the improvement works in the capital gain? You basically take your selling price minus your basis. So you bought a home for $250,000, right? And you sold it today for $650,000. So that you've got up $400,000. Now, if you have any capital improvement, you can add it to the cost, which is going to reduce your capital gain, which is going to reduce your tax liability. So any capital improvement that basically will increase your cost basis, and that will reduce your capital gain. So documentation is essential if you are making any improvement. I just want to make it clear to any new home buyer to consider that and keep that in mind. Talking about the Section 121, I think I was ahead of myself. I already discussed that. How do you combine Section 129 and 1031 exchange? You meet the 2 out of 5 years, you rent the property, or you keep it, or you do Airbnb, or you use it as an investment property, and then when you sell it, you get that partial exclusion, that 121, and the 1031 exchange. Step-up basis, this is a great tax code that I love for anyone who wanted to get tax-free for life. Basically, if you think about when you buy a home, think about your parents. If they bought, if someone bought a home 20, 30 years ago, maybe $50,000, $100,000, now it's worth $1.2 million. If they gift it to you today, you will carry their adjusted basis. So when you turn it out and sell it, you're the one that gonna pay the tax on all that capital gain. Versus if they keep the home in their name and then you inherit the home at the date of death when they die, you get it at the fair market value on the date of death. And that is the stepped-up basis. So let's say when they die, after long life, if they die and the home, worth $2 million or so, that would be your basis in the property. So if you turn around and sell it right away, there is zero capital gain. And that's the way of, that explains, I always have an issue with gifting. I don't understand why would people gift unless there are other reasons other than tax consideration, I'm pretty sure. But I usually, encourage our clients to look at the stepped-up base and take advantage of this, because this is a great way to pass the generational tax from one generation to the other generation. The same thing for the 1031 exchange. You keep deferring the taxes from one property to the other, and when you die, your heirs will get the tax with the investment at the stepped-up basis, and if they turn around and sell it, then they pay zero taxes. So this is a great tax saving strategy that you need to be aware of. Next slide, please. Okay, so I think I still have some time to address the tax question. So can I leverage my 401k tax-free to purchase a home? Yes, I think I just touched base on that. Borrowing up to $50,000 or half of what you have in your 401k. That's probably the best way. It's a purpose of taking a depreciation tax break with rental property. Your heirs pay tax on depreciation when inheriting the rental. Depreciation is one, this is, to me, is one of the biggest advantage of investing in real estate. I mean, forget about any other deduction. It's basically the IRS allows you to allocate the cost of the acquisition of your investment over years. So if you invest a residential property, you can depreciate the property over 27.5 years. If that's a commercial property, you can depreciate it over 39 years. So think about that. You go to Assad and borrow money to invest in the property, but the IRS will say, hey, we'll let you deduct the cost even before you pay off the, you know, the cost of the investment. So this is one of the greatest tax advantage of investing in real estate. And that's why everyone want to invest in real estate. So it is a non-cash deduction. You can take it every year, whether you have income or not, whether you have profit or not. And then at the end of the year, at the end of the life of the property, when you sell it, you want to keep in mind there is some, you know, I would say flaw with the tax code, because the IRS will looking to recapture some of this depreciation and tax you on that. Not all the cases, because it all depends on your tax bracket. So, but keep in mind, all the depreciation that you take over the years, it can be recaptured up to 25% tax bracket. But then, you know, you get that depreciation, and if you, you know, when your heirs inherit the property, they don't pay any taxes. Again, it's because of the stepped up basis. So they get the fair, regardless of how much taxes you pay or how much depreciation, the property, they look at the fair market value of the property, and that will be their basis. So there's no taxes to your heirs. What taxes do I pay when I rent out a property or taxes? It's an ordinary taxes. So if you have a net rental income, let's say you look at your gross rental income minus all the expenses, you know, mortgage, interest, deduction, HOA, repairs, maintenance, all the good stuff, and you look at the bottom line. If you have a rental income, that would be added to your gross income. And there is no special tax rate for that. It will just be considered active income, whatever your tax rate, you know, in that year. If you have a loss, you can deduct that loss up to $25,000 a year if your income is less than $100,000. So if your income is more than $100,000, then you lose $1 for every $10 additional income until you hit the $150,000. So from $100,000, you get a full deduction of $25,000 of losses. So if you have a loss for $5,000, $7,000, $12,000, you get the full deduction. Once you hit the $100,000 income, then the deductions start phasing out. And now what's called the passive loss limitation. Your deduction, the $25,000 start phasing out until you get to 150. At 150,000, you get zero deduction. But again, the loss doesn't go away. It just get carried forward to, you know, future years. So the loss gets suspended to future years. I hope I answered that question. Text I have. Okay, what are a few tax deductions for rental properties? Very much the loss, like any expenses related to that rental activity. So if you do any repairs, property management, any mortgage interest you pay on the property with no limitation, property taxes, repairs and maintenance, you know, if you do travel, you can write off some mileage. You know, just think about anything related to that property that you can write off against the rental income.
Thanks, Sammy. We had a couple in the chat
Sure.
Q&A as well. Is the money from capital gains, for example, like the sale of equity, not included in the calculation for the capital gains tax bracket?
Okay, I'm sorry, I'm trying to understand that question. So if the money from the capital gain, if the money from the,
the sale of equity, if you can see in the chat, or if Raymond wants to,
and that's
he's welcome
from,
to turn his mic on.
Yeah,
okay.
so to kind of clarify that, you mentioned that the capital gains tax is calculated based on like your income, right? So if you're making less than 40,000, it's 0, And
Correct.
then between that and like $500,000, it's 15%. So then like so for example, if I sold like 100,000 worth of equity, but my like wages is zero, would I like pay 0% tax or 15% tax?
0% capital gain taxes, not income tax.
I see.
So I'm talking about that. That's a very good question. So I just want to be clear. So when I say zero, it's a zero capital gain taxes, but you will pay income tax on your total adjusted gross income. So whatever, so let's say you have, you sold your capital gain at $30,000, right? And that's the only income you have. That's under 40,000. If you're a single taxpayer, you're paying zero capital gain, but you're paying income tax on the $30,000.
Gotcha.
Does that answer your question?
Yeah, it does. Thank you.
You're welcome.
We've got another one from Jeff Shea. Regarding the section 121 exclusion ratio, if we lived in the property for 6 years and then moved out and sold it 3 years later, would the ratio applied to the capital gains be 6/9, so 67, 0.67, 6 of the last 9 years, or 2/5, 2 of the last 5 years?
It all depends on what happened to the property in the last 3 years. So if these are non-personal use, if you leave the property vacant, didn't do anything, that's still non-personal use. So your capital gain will always be reduced for any non-personal use. Whether you leave the property vacant or you did an Airbnb or you rent it out, the last 3 years, you didn't treat the property as your primary home. So your property's capital gain is always going to be reduced.
Mm-hmm. And it's always the last years. It's like what's happened.
No, it doesn't have to be the last year. So I'll say the 2 years can be the first 2 years, last 2 years, or in between.
Okay. Can you use the borrowed amount from a 401k to the purchase of a first home only, or any home purchase?
That's a good question. And I think that's a good question for your 401k administrator, because some of them, it all depends on the custodian. Some of them, they have limitations. But I think to my understanding or what I've seen with my clients, once you borrow the money, they have no control of how to use the money. So you can do whatever you want, as long as you make the payments.
Thank you. Elizabeth, are we ready for all Q&A for Assad and Sammy? Perfect. I have a couple more for Assad from previous. We had one from Raymond just asking, when would one typically decide if it's a good time to consider refinancing? Is there any rules of thumb when it does come to refinancing? I know you had touched a little bit, but are there any special tips that you recommend?
So it's never a bad idea to do a mortgage checkup. Just like you go to the doctor and get a checkup, you could do a mortgage checkup and talk to a loan officer and let them know what your current scenario is, and they'll let you know what's going on in the market. If you're talking to somebody who is pretty communicative, they should be able to give you that information within 5 minutes or less. So they could do the analysis for you real quick and say, okay, this is what's available. It doesn't make sense for you to refinance right now. Maybe it's better to wait, and I'll ping you if rates get better. Or I know this other bank that can help you. Let me connect you with them. So it just really depends on your particular scenario.
That's very helpful, getting a checkup. Brett asked, will it be hard to get a good rate if our remaining mortgage balance is under the $700,000 amount?
So if it's under it, that's good. So anything below 765,000 is where you're seeing these really attractive rates right now. So there's two limits on the conforming. There's $510,400. That's the true conforming limit. And then because Bay Area is so expensive, they have a higher limit, which is the 765,000. So as long as you're below that, you'll get the very competitive rates. The only county in the Bay Area that is maxed out at 510,400 is San Joaquin County. So Tracy, Mountain House, the max loan amount over there is 510,400. But other than that, in the Bay Area, you can get up to 765 on that product and get very good rates.
Perfect. And then Hen asked if every time I refi, I'll be paying closing costs each time, right?
Yeah, closing costs are always there. They're either going to be built into the rate or you can pay for it out of pocket. So a lot of my clients prefer for it to be built into the rate. So if you're still, lowering your interest rate, maybe by at least 0.25%, and you're not paying anything out of pocket, then why not refinance it? Probably, you're going to lower your rate. You're not paying anything out of pocket. Also pay attention to the resetting of your mortgage. If you have a 30-year fix that's 7 years old, you're going to reset your mortgage if you do a new 30-year. So just be aware of that. As long as you know the whole scope of the situation and if it fits your goals, then yeah, it makes sense.
Good tip. And then this one I believe is for Sammy. Is HOA and interest on a rental property also deductible along with property taxes, property management improvements, and visits?
For rental properties, yes, not
Okay.
for primary home.
HOA and the interest on a rental is deductible.
Correct. That's right.
Very good. Didn't know that. Did anyone have any other additional questions for Sammy or Assad? We want to thank everyone for coming. We'll stay on for just a couple more minutes while we're closing out here. As you can see from the slide on here, we do have a couple more upcoming seminars that we'll be hosting. Our next one is 2 Wednesdays. We're doing every other Wednesday for webinars. The next one, 7 Steps to Selling Your Home with Wilson Leung. The next one will be Buying Investment Properties and Building Passive Income. That'll be with Jenny Locke, myself, and Calvin, one of her business partners. And the next one's Estate, Trust, and Succession Planning, protecting all of your assets that way. And then we will reroute again and go back to another guide for home buying. And so, yeah, appreciate everyone coming today and joining us.
Yeah, we will be sending a recording of this sometime this week. I'll have it uploaded either tonight or tomorrow, so within 24 hours. And I'm going to email everybody and also send a link to all of our upcoming webinars. So if you guys have any interest in joining what's upcoming, then please do register. So it's every other Wednesday, same time, 4:30 to 6 p.m.
And then if for some reason we don't have your email address, if you used a different email for the Eventbrite, just type it into the chat and we'll make sure you get the recording. Or you can reach out to Elizabeth at marketing.
My email is elizabeth@team WLREA. And so we had the open Q&A. And yeah, thank you so much for joining us, Sammy and Assad. Really great information today. If you guys want to further the conversation with either of these two, this is their contact information here. And I think that we have one more question.
It's a great question. Are there links available for our old webinars? And yes, they are. You should check out our team YouTube page, which has a lot of our past webinars. We want to stay as current as possible. So a lot of our home buying ones, and similar to today, we're always updating those with new information. So we always recommend you guys joining once we're starting the home buying one again. But check out our YouTube page. We've got a lot of our coming soons on there as well.
Yeah. I think so Rob had a question though. Did we go over this? Is HOA an interest rate? We did? Okay.
We did.
Cool.
I didn't know that.
Cool. Okay, thank you so much, guys. We'll hang out for just another couple minutes if anybody has any additional questions.
Oh, you got it. Just to confirm, Sammy, the capital gain tax limit for a couple is 500. And then to clarify, they both need to be on title. Is that correct?
Okay, so I just want to clarify this. So if we talk about the long-term capital gain, it goes from 0 to 20%. If you are on the, if your income is under 40,000 single taxpayer or 80,000 married filing jointly, it's 0. Then you go up to the next one. The next bracket is 15%. So 15% goes from zero, $80,000 income if you're married filing jointly, to up to close to $500,000, like $470,000 an exchange. So if you go up to that limit, then it would be 15%. If you are in the highest tax bracket, which is 37.9%, then you will be taxed at 20%. So there's no like a fixed dollar amount. You'll have to look at your ordinary tax rate. And usually most of the tax return will print your tax bracket at the bottom. You look at the tax summary, see your tax bracket, and that will determine your tax rate for the long-term capital gain.
Okay. And then David Chen, can you dive just a little bit more into the requirements of a 1031 exchange? He's asking when can I do a 1031 exchange if I just bought the home 6 months ago?
Okay, so good question. So the 1031 exchange, there are two main requirements. It doesn't matter how long you buy or you hold a property for. Number one, it's not available for personal, for primary home residence. So it's only available for investment property, whether you have residential, commercial, or piece of land, any type of real estate, but not your primary residence. So if you bought a property, investment property, and you kept it for 6 months, you want to exchange it, then you have to, number one, work with intermediary. You cannot do it yourself. That's one of the IRS requirements. So you just Google for 1031 exchange intermediary, and you find them everywhere. Costs about like somewhere between $1,000 and $1,500 to handle the whole transaction. What they do is they open an escrow for you, 45 days to identify the property or properties. So you can identify more than one, property to buy. And then once you identify the property, you have to close on any one of these property within 180 days. So as long as you meet those timelines, then your capital gain will be deferred. Keep in mind, it can be a little tricky when the transaction overlap 2 tax years. So you could start in 2020, and because of the 180 days, you close the deal in 2021. So in that case, you have an option to report that transaction in 2020 or the following year, 2021. But those are the main criteria that you have to meet. And when you hire an intermediary, I mean, assuming that these people, they've done that millions of times, they know what they're doing, you don't have to worry about all these time limits. That's why you're paying them. They guide you through the guidelines. So, but 45 days and 180 days, those are the two main things that you have to keep. And honestly, if you don't have any, if you're not expecting a capital gain, if you have a capital loss, then it's pointless. Why would you do 1031 exchange? So you want to do that because when you say you have a property, you bought it for 6 months, I don't know how much appreciation you got in 6 months, but if you think that you're going to have a capital gain that you want to defer, and you have some equity in 6 months, then probably it's worth to do or explore the 1031 exchange option.
Perfect. Thank you.
You're welcome.
Does anyone have any additional questions?
I think we're all set.
Okay, great. Thank you everyone for joining. I'll get the emails out with the links. We'll go ahead and send the slides too. And yeah, thank you so much for joining. Hope to see you guys at the next one. Thank you again, Sammy and Assad. Have a great evening.
Thanks for having me. Appreciate it.
Thank you.
Take care, guys. Bye.
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 Thank you.
Lizzie, don't end quite yet.
Oh, okay.
Sorry. Just need to save my chat.
Cool. Can you send that to me after?
Oh, the full chat, like all the chat? Let me see.
That's okay, actually. I can find it in Zoom.
Okay. Yeah. Someone just requested a contact number, so I wanted to make sure I jotted down his info.
Cool. Thank you for moderating the questions.
Absolutely. Made some good ones.
Yeah. I'm gonna have to rewatch this. This is great.
I was gonna say, I learned some stuff. I know It's always like you're trying to moderate the questions, so sometimes you're just, you miss what they say. I've done that before where I'm like, I just have to come back and watch this.
Yeah. Okay, stop the recording yet.
Okay. I got what I need. I'm gonna head to my showing.
Okay, good luck.
Thanks.
All right. Gonna end now. Good night, everyone.
Bye, guys.
Night, Jenny. Night, Jay. Bye.